Today, we'll dive into an analysis of Wendy's major competitors and industry, exploring market performance, competitive performance, and the key factors influencing their success and growth. With the industry landscape in mind, let's take a closer look at how Wendy's top rivals are performing and what sets them apart in this competitive arena. McDonald's, established in 1940, dominates with $25.9 billion in sales and a 16.38% market share across 43,477 locations. Wendy's and Burger King have similar sales around $2 billion and market shares around 1.4%, with 7,242 and 19,732 locations respectively. From this, we can clearly see McDonald's as the leader. In terms of revenue, McDonald's is clearly by far the market leader with 25.92 billion in revenue in 2024 and a compounded annual growth rate of 10% from 2020 to 2024. For the battle for second place, Burger King gets the slight edge with 2.3 billion due to a bump in sales in 2022 and 2024 due to recent acquisitions, and Wendy's has a 2.2 billion revenue in 2024. For net profit, McDonald's is still leading with 8.2 billion in 2024. Burger King takes the second spot with 710 million in 2024 profit, while Wendy's has 205 million. Moving on to revenue per restaurant, McDonald's still leads with approximately 59.62 million per restaurant in 2024, both company-owned and franchised. Wendy's ranks second with 38.23 million per restaurant, and Burger King has 11.6 million per restaurant. This means that although Burger King ranks second in terms of total revenue and overall net profit, Wendy's earns more per restaurant than Burger King. This is still the case for net profit per restaurant. Generally, Wendy's had a higher current ratio over the years compared to the two other companies, making it better positioned to pay off its short-term debts using its short-term assets. This is also the case when using its most liquid assets. For operating margin, McDonald's and Burger King are performing similarly with margins around the 40 to 50% range, while Wendy's margin is at its peak in 2021 with 19.34% and slowly declining to 16.53% in 2024. For cash ratio, Wendy's still tops the other two. This is a strong stance for Wendy's in terms of liquidity. However, it might raise concerns for capital inefficiency. Moving on to return on assets, Burger King is in the lead, showing how profitable the company is relative to its assets. Its decline from 21.2% in 2023 to 15% in 2024 can be explained due to the recent acquisition of the remaining 85% equity interest in Carol's Restaurant Group Incorporated, which added around 1,017 Burger King restaurants. Wendy's still lags behind the other two with 3.8% due to its inefficiency or poor asset utilization. As for inventory turnover, Wendy's has a high ratio in 2024 with 15.8 compared to McDonald's 8.94 and Burger King's 6.7. This means that the company is efficiently selling and replenishing its inventory. With the liquidity ratios, return on assets, and inventory turnover, Wendy's show efficient day-to-day operations, but is not using its asset base effectively to drive returns. This means that the company is hoarding cash and there may be a need for better capital collection. When compared to McDonald's and Burger King, which shows a more typical performance of a mature company in this segment, Wendy's still lags behind the other two. For inbound logistics, Wendy's uses a cooperative purchasing model through QSCC, focusing on efficient logistics and fresh inventory, but lacks the extensive supplier networks and long-term partnerships seen in McDonald's and Burger King. McDonald's leverages a global supply chain with strong relationships with local farmers and suppliers, ensuring efficient logistics and freshness through backward and vertical integration. Burger King, while also using cooperatives, has a robust network of distributors and exclusive beverage contacts, offering greater purchasing efficiency compared to Wendy's decentralized approach. In terms of operations, Wendy's lacks the advanced automation and global consistency seen in its rivals, particularly McDonald's technology like the ABC system. Burger King also focuses heavily on franchisee training and inspections, areas where Wendy's is less intensive. McDonald's operates over 40,000 restaurants globally with a standardized process and innovative systems like the Made for You kitchen and automation tools, ensuring efficiency and personalized service. In contrast, Burger King operates mainly through a franchised model with strict adherence to cleanliness, speed, and quality standards, relying on franchisee training and inspections to maintain operational consistency. In terms of delivering their offerings to the customers, this area shows us why McDonald's is the market leader. Wendy's offers standard channels like dine-in, take-out, drive-thru, and delivery, but lacks the logistical innovation and specialized formats seen in McDonald's, such as Sky-Thru and McSky, or the infrastructure upgrades of Burger King. McDonald's stands out with unique service formats and strong digital integration, while Burger King focuses on drive-thru and delivery with ongoing improvements. For this part, we can see that all companies have exhausted their means to improve their visibility on the general public, both on the local and global scale. However, Wendy's lacks the global consistency and localized campaigns seen in McDonald's, such as the extensive use of collaborations and merchandise marketing, like the BTS meal and Travis Scott meal that McDonald's leverages for brand differentiation. Wendy's also doesn't match McDonald's scale of investment in marketing, which was $388.9 million in 2023. Additionally, while Burger King focuses on innovative promotions and tech-driven marketing, Wendy's lacks similar emphasis on technology integration in marketing and advertising. McDonald's and Burger King prioritize efficient customer service through digital platforms like mobile apps and self-order kiosks, with McDonald's adding family-friendly features and special occasion services, while Burger King focuses on speed, cleanliness, and friendliness. While Wendy's customer service is solid, it lacks the extensive use of technology and convenience-driven services, like mobile apps, kiosks, or loyalty programs that both McDonald's and Burger King have integrated into their operations. These features contribute significantly to customer experience by providing greater convenience and engagement. In terms of firm infrastructure, McDonald's and Burger King both operate with strong governance structures, with McDonald's emphasizing cost control, brand protection, and franchise compliance, while Burger King focuses on financial oversight under its parent company, Restaurant Brands International, and refranchising remodeled locations. Wendy's, in contrast, has a solid governance framework but could benefit from a more defined emphasis on cost control strategies and franchise management to align with the global approach seen in McDonald's and Burger King. For human resource management, McDonald's and Burger King prioritize extensive training programs and career development, with McDonald's offering global managerial training through Hamburger University and flexible workplace programs, while Burger King focuses on onboarding, leadership development, and mentoring. Wendy's, while offering strong training and benefits through Wendy's University and diversity initiatives, lacks the global managerial training platform and flexible programs that McDonald's and Burger King provide, which could further enhance employee growth and retention. In terms of technology development, McDonald's and Burger King heavily invest in digital infrastructure, with McDonald's offering self-order kiosks, mobile ordering, and a loyalty program, while Burger King modernizes drive-thrus and integrates systems for efficiency. Wendy's, although leveraging AI and cloud services, lacks the same level of customer-facing digital tools such as self-ordering kiosks and a personalized loyalty program, which could enhance customer engagement and operational efficiency. Lastly, for procurement, McDonald's and Burger King both maintain extensive supplier networks, with McDonald's sourcing specific ingredients from established suppliers like Lopez Foods for beef and Keystone Foods for chicken, while Burger King enforces an approval process for suppliers and offers rebates based on purchasing volumes. Wendy's, in comparison, relies on a more streamlined approach with fewer suppliers and a focus on regulatory compliance, but lacks the breadth of supplier relationships and incentive structures seen in McDonald's and Burger King, which could provide greater flexibility and cost efficiency. Moving forward, here is a comparative overview of the current strategies employed by Wendy's, McDonald's, and Burger King. At the business level, Wendy's adopts an integrated cost leadership and differentiation strategy with a heightened focus on quality. Corporately, it is transitioning from related linked diversification to low diversification. At the cooperative level, Wendy's has partnered with Arby's to form a strategic sourcing group to enhance cost efficiency. Internationally, it employs a multi-domestic strategy, aligning offerings with low market preferences. McDonald's utilizes cost leadership alongside a differentiation strategy. It maintains high related constrained diversification at the corporate level. Cooperative initiatives include joint ventures in Japan, majority ownership in Russia, and development efforts in South America. Its international strategy also follows a multi-domestic approach. Burger King implements an integrated cost leadership and differentiation strategy. It pursues high diversification at the corporate level. Cooperatively, it has marketing alliances with DreamWorks and partnerships in China. It too applies a multi-domestic strategy to cater to local tastes. To assess its competitive advantage, let's look at the individual VRIO analysis of the three companies. The table presents a VRIO analysis of Wendy's key resources and capabilities. All listed, such as brand reputation, proprietary recipes, human and physical resources, intellectual property, cybersecurity strategy, and R&D, are considered valuable. However, none are assessed as rare, inimitable, or organizationally supported to a degree that would provide sustained competitive advantage. As a result, each resource yields only competitive parity, indicating that while Wendy's holds essential assets, these do not currently differentiate it strongly from competitors. Moving forward with McDonald's, the company's partnership arrangements and proprietary recipes provide only competitive parity due to a lack of variety and inimitability. However, its human resource development, supply chain, and food production system are valuable and rare, giving it a temporary competitive advantage. Notably, the globally recognized brand and trademark portfolio meet all VRIO criteria, resulting in a sustained competitive advantage. These findings highlight McDonald's strategic strength in branding and trademarks, while its operations and people systems provide moderate yet significant competitive benefits. Lastly, let's look at Burger King's core resources and capabilities. Our assessment found that several key areas provide competitive parity, including brand reputation, proprietary recipes, human resource development, marketing, innovation initiatives, and supplier relationships. While valuable, these attributes lack the necessary rarity and inimitability for distinct advantage. Conversely, Burger King's expansive supply chain demonstrates both value and rarity, resulting in a temporary competitive advantage. This suggests a current strength in operational logistics that is not easily replicated by competitors. Now let's look at the core competencies and key areas needing improvement for the three companies. Under competencies, we see each brand's strengths. For Wendy's, it is its fresh ingredients, tech innovation, sustainability goals, and premium brand positioning. McDonald's highlights its global brand reach, digital transformation, sustainability initiatives, supply chain mastery, and localized menus. Burger King emphasizes value offerings, global expansion, plant-based leadership, and sustainability efforts. For areas needing improvement, Wendy's faces declining U.S. sales, store closures, and potential risks with its edgy branding. McDonald's is dealing with declining U.S. sales, operational delays in tech adoption, intense market saturation, and franchise tensions. Lastly, Burger King struggles with a limited breakfast market share. over-reliance on franchisees, and negative brand perception and confusion in its value proposition. Now let's look into the quick service industry as a whole, starting off with Porter's 5 Forces analysis. We evaluated the threat of new entrants as low to moderate. While the market remains fragmented with around 250,000 operators and independents making up a big portion, barriers still limit new competition. Growth in the industry, though steady at a 10.35% CAGR, may not be fast enough to attract new players. Meanwhile, established brands like McDonald's and Burger King enjoy a significant incumbency advantages, including economies of scale and strong brand recognition. We evaluated competitive rivalry as moderate to high. While diverse customer segments help soften rivalry, other factors ultimately outweigh this effect. The market is led by large, well-equipped players like McDonald's and Burger King, who have already invested heavily in strategic innovations. With industry growth projected at only 10.35% CAGR from 2025 to 2030, slow expansion further intensifies competition. We evaluated the bargaining power of suppliers as moderate to high. Similarly, while wide availability of undifferentiated ingredients like flour and potatoes give chains flexibility to switch suppliers when needed, other factors also outweigh this. Key sectors like beef and beverages are highly concentrated. Four major meat packers handle 85% of U.S. beef purchases, while Coca-Cola and PepsiCo dominate the soft drink market. Many suppliers also serve multiple industries, giving them less dependence on quick service restaurants. We evaluated the threat of substitutes as moderate. Alternatives like meal kits and grocery prepared foods are on the rise, with a meal kit market valued at $5.9 billion in 2024 and projected to grow at 13.1% annually through 2034. Low switching costs further increase their appeal. However, the core strengths of QSR, which are speed and convenience, remain difficult for these substitutes to match, especially for consumers who prioritize quick, ready-to-eat meals. We evaluated the bargaining power of customers as moderate to high. Switching costs are low and customers are highly price sensitive, especially among students and low-income groups. Emerging segments like healthy and ethnic fast food also give consumers more choice and leverage. Strong brand loyalty still exists for certain chains, such as Jollibee among immigrant Filipinos in the US, which helps reduce the likelihood of switching and slightly weakens buyer power. However, this does not significantly influence the entire market. With this, our overall assessment of the attractiveness of the quick service restaurant industry would be low to moderate. Now let's dive into our strategic group map, where we've analyzed the position of Wendy's, McDonald's, and Burger King based on pricing and menu diversity. McDonald's is positioned in the low to mid price range with a moderately diverse menu, sticking largely to its core offerings with some variation like breakfast and seasonal items. Burger King sits in the mid-price category and offers a moderately high diverse menu, with efforts to innovate such as plant-based burgers, while maintaining its classic flame-grilled identity. Wendy's, also mid-price, stands out with the highest menu diversity, offering fresh ingredients and a broader range of items including salads and premium sandwiches. This map shows how each brand positions itself uniquely to attract different customer segments, whether through price, variety, or both. For the QSR industry, we have identified 5 key success factors that can drive competitiveness. First, operational efficiency and speed of service are vital. Customers expect fast, consistent experiences, so streamlining workflows and leveraging automation is essential. Second, technology adoption enhances convenience and engagement through mobile apps, self-service kiosks, and data-driven decisions. Third, a targeted marketing strategy allows QSRs to connect with specific audiences, using personalized promotions and digital channels to build loyalty. Fourth, product development and innovation keep menus fresh and appealing, helping brands adapt to evolving consumer tastes without sacrificing efficiency. Lastly, strong supply chain management ensures quality, reliability, and cost control, all while supporting sustainability goals. In a fast-moving industry where consumer expectations evolve by the minute, success isn't just about serving food. It's about serving it smarter, faster, and with purpose. The QSRs that win will be those that turn efficiency, innovation, and insight into their everyday ingredients.